So required, compute the industrial building deductions for the year 2016 and 2017. So we go through the illustration again. They had started operations on 1st of January 2016. Remember we said the assets must be used in the year of income under consideration for business purposes for the capital allowances to be deducted against taxable income. So they acquired a showroom. A showroom falls under, in our previous lesson, under industrial building at 25% per annum, meaning that the 2 million is supposed to be claimed at 25%, 2016, 2017, 2018, and 2019. Then offices worth 3.5 million. Again, offices will qualify for IBD at 25%. They constructed a staff dispensary. Staff dispensary is a building in use for the welfare of workers at a cost of 5 million and brought it to use on 1st of May. Now, remember we said that industrial building deduction is going to be prorated or to be proportionately to the period that, for example, the staff dispensary was used. So since it was, they started using it on 1st of May, we're going to count from May to December. So we will have 8 months: May, June, July, August, September, October, November, and December, 8 months. Then they also constructed a warehouse at a cost of 7.5 million, and this was brought to use on 1st of July. Again, they have used it for a portion of the year, therefore we prorate IBD to the period that the building was used. In this case, the period that the warehouse was used. So they used it in July, August, September, October, November, and December. That is 6 months. Then in the following year, 2017, they bought labor quarters, and these were occupied effective 1st of March. So 1st of March to 31st of December, that is 10 months. So March, April, May, June, July, August, September, October, November, and December. Those are 10 months. So required, compute industrial building deductions for the years 2016 and 2017. Now we're going to start by looking at an IBD schedule. So this allows you to compute the IBD that you're going to claim for the number of years that you will have. So, and the reason why we need a schedule is because we are claiming IBD, for example, on a showroom for 4 years, on a warehouse for 10 years. So we need a format or something that shows us how we're going to claim it for the next 10 years. That is what we're calling an IBD schedule. So IBD schedule starts with the name of the company. So we will have Matunda. So you have Matunda Limited, IBD schedule. So it will have columns that show us the balance brought down and the balance carried down. So let's have the schedule and then we'll discuss the schedule. So we have qualifying asset, qualifying cost, then we have rates, and we have written down value, brought down, or we can, let's interchange those two. Written down value, brought down rates, IBD, written down value, carried down. So let's first discuss what goes into what. This is the qualifying asset. So here we will have the building, depending on the nature of the building. So we can have rental residential houses, we can have infrastructure, we can have a showroom, we can have a warehouse, we can have a bridge or a tunnel, or a hydropower undertaking, or what you said an industrial building is, you're going to have it there. Qualifying cost is the cost that we have incurred on that particular building. So if it is a warehouse, the cost of constructing the warehouse up to the first time that we used it. If it is a bridge, the cost of constructing the bridge up to the first time that we used it. So the total cost of coming up with or buying the asset, either constructing the asset and then up to the first day of use, that is the qualifying cost. So we said IBD is granted on straight line basis. So you will have a rate here and then you base it on the qualifying cost. This in accounting is what would be called the historical cost of the asset. So you take the given percentage times the historical cost. Only that for tax purposes, we don't have historical cost. We call it the qualifying cost. Then written down value brought down. Now this is the equivalent of net book value in accounting, but we have it to track the residue that is remaining for us to claim on a given asset over the remaining period of time. Why? Because we've said, depending on the nature of the industrial building, we're going to claim IBD either for 4 years or for 10 years or for 6 years or for 2 years. So we need, this is what allows us to track how much is remaining. So we have written down value, brought down, then the rate, then the IBD. So IBD, for us to get here, a figure here, we take the rate, you multiply by the qualifying cost. Remember, if the building has not been used for the whole year, this IBD here for the first year of use is going to be prorated to the period that the building was used, and then you have the written down value carried down. So this is the schedule that you're going to use. So we want to start with 2016. So in 2016, we go back to our question. Matunda, they acquired a showroom at 2 million, and this is at the start of the business. So since they started in 2016, that means the showroom was used for the whole year, and so were the offices used for the whole year. So we have showroom, qualifying cost is 2 million. This is the first year of use, so we have no residue that has been brought down. Then the rate is 25% from our previous lesson. So IBD is 2 million times 25%. 25%, that is 500,000. This is 1.5. So how you've calculated that is, fine, it is a showroom, and the rate is 25% of the qualifying cost, which is 2 million. So to get the IBD, we take 25% of 2 million, we get 500,000. It was used for the whole year, so we are not prorating proportionately to the period of use. And the written down value carried down is the residue that is remaining. So what this 1,500 means is that the qualifying costs we are going to claim in 4 years, we're going to claim 2 million. But in 2016, the year of our first use, we have claimed 500,000. So we were supposed to claim 2 million, we claim 500,000. What is remaining is 1.5 million. Then the other one is office. These two fall under commercial buildings. It was 3.5 year of first use, therefore we don't have that. 25%, we compute in the same way. We get 25% of 3.5 million times 25%. That gives us 875,000. 875,000, and the remaining, when we get 3.5 million minus 875,000, we get 2,625,000. Then still in our question, we are told that the constructed staff dispensary, we said this is a building for the use of workers, then at a cost of 5 million, and brought it to use on 1st of May. So staff dispensary, because it has been used for a proportion of the year, we shall have a working. So we can do that working here. Working 1, This is the area for workings. 1 IBD on staff dispensary. So qualifying cost is, let's get the qualifying cost. It is 5 million. Qualifying cost is 5 million. Then period of use, it was brought into use on 1st of May. 1st May 2016. The rate is 10%. This rate is derived from our previous lesson where we had the corresponding rates. So we're saying we are going to prorate to the period of use because it is from 1st of May up to 31st of December. So these are May, June, July, August, September, October, November, and December. These are 8 months, which is less than 12 months. Therefore, prorate IBD to 8 months. So what that means is that we are prorating annual IBD. Let's insert that. Very important. So we need to get annual IBD. So annual industrial building deduction is equal to the rate 10% times 5 million. The qualifying cost, which gives us 500,000. Just a moment. Correct, 500,000. So we prorate this to 8 months. So 8 divided by 12 times 500,000 times 8 divided by 12. 3, 3, 3, 3, 3, 3. So we paste that here. Staff dispensary qualifying cost was 5 million. Year of first use, 10%. So from our working one, we get 3, 3, 3, 3, 3, 3. So we have the remaining is 5 million minus 4 million. 666,667. Then we have they also constructed a warehouse at a cost of 7.5 million. So warehouse. Qualifying cost 10%. And this is from 1st of July. So working 2, IBD, 4, warehouse, which was utilized from 1st of July to 31st of December. So period of use is 6 months. July, August, September, October, November, and December. So annual IBD is equal to rate, which is 10%, times the qualifying cost. This is 10% of 7.5 million. So this gives us, we cancel 1, we get 750,000. So prorate to 6 months. This is 6 over 12 times 750,000. So that is just like 750,000 divided by 2, 375. So the remaining amount is 7.5 million minus 375,000, that is 7125, 7125. All right, we are done with 2016. So we can now add up our total IBD for 2016, which is 500,000 plus 875,000 plus 333,333 plus 375,000, that is 2,083,333. So that is the IBD for 2016. But remember, if you look at this rate, this is for 4 years, for 4 years, for 10 years, for 10 years, because it's 100 divided by 25 and 100 divided by 10. So that takes us now to 2017. So you're going to have 2017 here for ease of comparison. So remember, we had said earlier, you claim capital allowances in the respective year. So that is why we have double underlined here, because it means for 2016 you're done. You're claiming 2,083,333 shillings. We are done with that. So we said if you forget to claim, you cannot claim in arrears. So 2017, the same assets, because they've not exhausted their lifespan, will still qualify for the same assets. So we will have showroom, 2 million, qualifying cost is constant. Now we have, this is not the first year of use, so what we had carried down is what we shall bring down, 1.5, then 25%. Because it is straight line, it means we are claiming an equal amount every year. So we claim 500,000. But now, we are remaining with 1 million. So let's see how 1 million, we have arrived at a million. We were supposed to claim 2 million for 4 years because we are claiming at 25%. So in 2016, we claimed 500,000. In 2017, we have claimed 500,000. In total, we have claimed a million out of 2 million. So we are remaining with a million, which we shall now claim in 2018 and 2019. So, or you can take, this is what we have, the residue to be claimed in the future years is 1.5. So when we claim this year 500,000, it means our residue carried down is equal to residue brought down minus what we are claiming. 1.5 million minus 500,000, it gives you a million. Then offices, we were supposed to claim for 4 years, 3.5 million. We claimed the first year, and the remaining amount was 25,000. So we are claiming at 25% of the qualifying cost, which is 875. Like we said under showroom, this is straight line, meaning that so long as you have claimed for the whole year, that remains constant. So that's why we have 500, 500, 875, and 875. So our remaining amount is 25,000 minus 875,000. That gives us 1750. Okay, then we have staff dispensary. We are claiming 5 million over 10 years. We claimed the first one. What was remaining is 4, 6, 6, 6, 6, 6, 7. And we are claiming at 10% of the qualifying cost. Now, this changes. to 5 million times 10%. 500,000. The reason is that in 2016, we go back to our working there. In 2016, we had used our staff dispensary for 8 months. So we prorated the annual IBD. This 500,000 is what we have arrived at here. But because we used it for a portion of the year, we were supposed to prorate to 8/12. Because we said in IBD, you always prorate to the period of use. So 8/12, that is what gave us 333. And this is what we had for the first year. But because for 2017, the business has been in operation for the whole year, and we have used the dispensary for the whole year, we're going to claim 10% of the qualifying costs, and that is 500,000. So our remaining amount is 466,667 minus 500,000. That is 4166,667. Then we claim on the warehouse. Warehouse qualifying cost was 7.5 million. We claimed what was remaining was 7,125,000. We are claiming at 10%. So again, we claim 7.5 million times 10%. That is 750. And the remaining amount is 71,25,000. 63,75,000. So again, this and that are different. The reason is in that working that we have there, that the IBD for the first time, the 2016, when we first used warehouse, we used it for 6/12 or 6 months out of a possible 12 months in a year. So we prorated that to the period of use, which is half the year. So we took 750, we divide by 2, that gives us 375. But this time we have used it for the whole year. So we are claiming 10% of the qualifying cost. Now back to our question. In 2017, they bought labor quarters, and these were occupied from 1st of March. So there is labor quarters. The labor quarters had been constructed at a cost of 7.2 million. So we will do our working for that. Working 3, IBD for labor quarters. So qualifying cost is 7.2 million. Then the rates, this is a building for use or for occupation by workers, 10% of qualifying cost per annum. Period of use, they used it from 1st of March of March 2017 to 31st of December 2017. Now this is March, April, May, June, July, August, September, October, November, and December. This is 10 months. So we compute annual IBD, which is equal to 10% of the qualifying cost. This gives us, we cancel out 720,000. Then we prorate annual IBD to 10 months. Why? Because in IBD you always prorate to the period of use. So we will have 720,000 times 10 over 12. So 720 times 10, 600,000. So that is what we will have here. So it's the first year of use, so you don't have written down value. Brought down, we're using a rate of 10% from our working. That is giving us 600,000. And then the remaining amount is 7.2. 6.6 million. So IBD for 2017 is 500. We are adding this column here. 500,000 plus 875,000 plus 500,000 plus 750,000 plus 600,000. 3,225,000. Okay, so this is our total IBD for 2017. We are now going to have a summary of the two IBDs. So summary is that you have 2 years. You have 2016 and you have 2017. This is summary of IBD, very important. So you have 2016 IBD is this amount, 2,083,333. 2017, 3,225,000. So this is where now you'll have others. So if you have a question, if you to put it in the context of a question, you will treat this as an allowable expenditure. So that is what you will have. Now we've come to the end of our question. In our lesson, we illustrated how to compute IBD, or Industrial Building Deduction. We looked at the Industrial Building Deduction schedule or schedule, and we said what is important is you have to state the date when you're preparing that schedule, because these dates, the rates tend to change with the years. So you have the year, then we will have this, the different columns. We said in the column where you have qualifying asset, you're going to put the building, the nature of the building that qualifies for IBD. Qualifying cost, cost of construction of that building up to the day of first use. And of course, we had said earlier, you exclude the items in that building that would qualify for wear and tear, like laptops, furniture, fittings, and such. Then he said, for each building, you're going to have a different rate. So you apply the specified rate. These rates, we have said, they are given by the commissioner. Then, to get the industrial building deduction per annum, you're going to take the rate, you multiply by the qualifying cost, which we had said could also be in financial accounting, is what you call the historical cost. So you will get it here. But like for these two cases where a building is used for a proportion of the year or a portion of the year, you're going to prorate to the period of use. So we have seen these two. These are the two workings for staff dispensary and for the warehouse, and then for 2017 for the labor quarters. So every time you've used the building for lesser than 1 year, you're always going to prorate annual IBD to the period of use. So in this case, the period of use was 10 months, from 1st of March to 31st of December. Then what you're interested in is this. Now, you said you're going to claim this. This schedule allows you to have a track of the claims that you're making to the commissioner. So we did it for 2016 and we also did it for 2017. So what we wanted to illustrate in the 2 years is this change here, that you're using 10% of that, 10% of the same amount, but because in 1 year you've used the building for a proportion of the year, you are going to prorate your IBD, while for the other year, IBD changes because you've used the building for a whole year.